debt issuers have been bracing for today's S&P downgrade of Fannie and Freddie. Other key players in the U.S. financial system may also see a downgrade. Now, how much of a risk would this be? Well, joining us now is Dino Kos. He's managing director at Hamiltonian Associates. Dino was with the New York Fed for over 20 years. Well, S&P also downgraded the New York Fed yesterday. Dino, welcome here to InBusiness. Good to have you on. The ripple effect here goes far and wide, certainly goes beyond U.S. borders. What do you think are the most immediate impact? I mean, we're not seeing really the Treasury markets being impacted, except that more money is going into Treasuries.
Well, that's one of the ironies, which sort of makes people ask, well, what is the financial impact of this on Treasuries? As you say, actually yields are going down rather than up, which is what one would think. The other aspect of this is, what did we really learn from S&P? I would argue we didn't really learn that much. The debt has been expanding in the U.S. massively over the last 3 years, not just over the last couple of weeks. But this was a recognition of what has happened, as it were. Where I think I would take issue with S&P quite a bit is the timing of the announcement and how they handled it. It seems to have been very sloppily handled. And the fact that they did it now at a time when Europe is really having very serious sovereign issues and at a time after the stock market had a very difficult last week, I think they could have chosen a better time to roll this out.
Well, when would have been the right time? They're sort of stuck between a rock and a hard place, right? They've been criticized for not calling what happened during the subprime mortgage well ahead of it happening. Should they have waited until things got worse?
Well, it's not. I mean, look, right now we have a situation where there is real questions about Europe. Real questions about Europe, real questions about how that will be resolved, real questions about the European banking system, and even about the sovereign standing of those countries.
Did this downgrade destabilize Europe even more than it already was?
I didn't need any more help. This just added, because if the U.S. is not AAA, is France really AAA? Is Germany really AAA? Is UK? So it really raises questions about all of those others as well.
Do you expect to see more comments on those sovereign credit ratings? France in particular is one that everyone's paying attention to.
Absolutely, because if those so-called stronger countries will support the Italy and Spain, then aren't they going to, in effect, going to be degraded as a result?
All right, in terms of borrowing costs, obviously we're not seeing anything happen immediately, but some economists have said we'll see borrowing costs rise 60 to 70 basis points. That could dent the economy by about $100 billion a year. If we don't see the Treasury market moving, are those costs really going any higher?
Well, two quick points. One is Japan was downgraded 10 years ago, and they're borrowing at 1%. The second aspect of it is, again, is the U.S. still has a strong economy. We still have a lot of issues to work through. The Congress has to work through them. If they do, then at some point the U.S. can still come back to AAA.
All right, Dino, thanks so much for joining us. Appreciate your perspective on what is happening in that market. That was Dino Kos, Managing Director of Hamiltonian Associates.